Hello and welcome back to the channel. You're listening to the Royalty King, and today I have an update for one of my favorite royalty stocks. Before we get into it, guys, please do like and subscribe to the channel. So many views and roughly 50% of you are not subscribed. So if you get any value out of this, I'm making it free to consumer content. Please do like and subscribe is all I ask. If you're interested in joining me either via live stream or in person in Boca Raton in a couple of weeks' time for Uncle Rick's Natural Resource Investment Symposium. Links to get your tickets will be available in the description. So let's take a look, guys, at one of, I don't know why it doesn't have the same kind of exposure that I believe that it should. It's a really, really interesting company. I've been writing about it for a few years, and that is, of course, Gold Royalty. So we're going to take a deep dive into the company itself, the macro thesis, why I'm so interested in gold royalties, precious metals royalties and streamers. And in spite of the roughly 58, 59% upside since I really started banging the table on this particular stock, what do I believe it's worth today? So let's get into it. Disclaimer, nothing I say is advice. It's obviously me documenting my opinions and my journey, sharing my thoughts with the world. Quick recap, and I've written these notes in rough freehand as if I were thinking out loud. That's the format for today. Hopefully you guys enjoy it. Every angle that I see, every time I look at an investment theme, a sector, an industry, I play a potential idea out over 3, 5, 7 years' time, they're all generating fiat currency. And I ask myself, even if I get a wonderful investment result, what am I then going to do with the end proceeds? And I'm always going to be looking to somehow at least beat the debasement of the fiat currency, and likely the benchmark, the obstacle, the hurdle rate to that is simply gold, arguably Bitcoin. So central banks around the world still, since 2014, they started buying a lot of gold. They're still continuing to buy gold. How am I going to outperform that if that's my baseline? And I think it'll do probably 9 to 10% a year. So that should be 8 to 10% should be roughly my discount rate, because my opportunity cost will be simply buying gold bullion. One of the most reliable ways for me to outperform is to simply take a derivative of that thesis, and a superior derivative of that thesis to me is the gold royalties. Another derivative might be the producers, the explorers, the developers, those types of things. But for reasons that I've spoken and written about ad nauseum, I don't believe they're a superior business model. In fact, I think they're inferior, and most people will not outperform the metal itself. That's my take. So gold royalties. Bitcoin, of course, will be a hurdle rate. It's interesting, and we're still in relatively uncharted territories, but a lot of questions have been answered around Bitcoin, not so much as a currency, a medium of exchange, but certainly around a store of value. So what would be a superior derivative? And if you're a premium subscriber, you'll know what I think is a premium a derivative of that particular commodity, currency, whatever you want to call it, store of value. Royalties. Okay. When we take a look at the royalty sector, things have moved over the last 2 years. And so we've seen the big guys, the Francos and the Wheatons really take off. I think Wheaton in my portfolio is up 90 odd percent, 90, 95%. Franco's starting to catch up now that we're getting some light around the situation regarding Cobre Panama. Then you had all these juniors, so mid to junior royalty companies that were trading at, say, Gold Royalty was around about a third of its book value when I really started pounding the table on it. These guys, the Metallas, the Gold Royalties, even up slightly bigger companies like a Cisco and Sandstorm were trading at big discounts to their NAV. And one of the key tenets of this thesis of investing in some of the smaller guys would be that's where the growth potential is. And at the same time, there was a heavy discount to the NAV. That's starting to close. And the reason is, which supports the thesis, is that the gap is going to close in NAV one way or the other. They're either going to get the market recognition and have the market bid them up towards their NAV, and or you're going to see the bigger guys just simply buy them out at a 30, 40% premium, which for them will be an absolute bargain. And so that's what I see is happening. And if you've been following my work recently, you'll know the news around in the Permian, so slightly different, but still royalty-based idea, Venom or Viper Energy buying out, taking over CTO Royalties, which was ridiculously cheap. I think they're going to be great cost synergies. There's a piece on the Substack that you can read all about that and how I see this as a major, major move for Viper Energy becoming essentially the second largest royalty player or pure play royalty in that Permian space. And no one seems to talk about it, which is wonderful. Gold royalty is probably well, it has been my preferred way to express this smaller royalty thesis. I'm hoping to get an interview with Peter Beckney at the Rules Symposium, so make sure you keep your eyes out for that. Things have changed. Gold royalty now, according to the latest updated presentation in June, the company does a good job of continuing to update their corporate presentations. They believe they're trading at about 80% of their NAV. It was down around half NAV, which is interesting. The re-rating potential is certainly on the cards for the two reasons that I mentioned prior. Just showing a similar thing, just giving a more broad view of the peers in that sector. So down around the smaller 100 million market cap guys, they're being fairly valued in terms of Vox and Elementis. Metalla and Gold Royalty, I think, are bigger and being discounted more heavily. And I think you'll start to see them close the gap around sort of the one times NAV. So, quick reminder, if you haven't already seen some of my pieces on the company and these theses, investment themes that I'm telling you about more broadly, here I've compared the greatest, certainly precious metals royal company, arguably the greatest royalty and streaming company ever, Franco Nevada, with Gold Royalty when they were at similar valuations in terms of the contracts on their book and their valuations and the type of revenues that they might be able to generate. So I highly recommend that you check that out. Seemed a very controversial theme when I wrote about that slightly less than a year ago, but I think it'll start to make more logical sense to people now. Unfortunately, sometimes people just need that price action in terms of confirming the conviction. In any case, I've taken a quote here to share with you guys. What I wrote was that in 2007, with a market cap of roughly 1.2 billion, Franco held 191 royalty contracts in his portfolio versus Gold Royalty today at 242 contracts with a market cap at the time, of course, of only 224 million. Albeit most of these are yet to hit production, they're getting contracts on exploration development projects. Mainly, a rough estimate of Franco's revenue per contract sits at about 3 million per annum per contract. So if you were to, and this is very, very rough, if you were to do the same thing with Gold Royalty, it's not difficult to imagine a future in the sort of medium term where the company can start to earn its current market cap in revenue every year. And so if you imagine that opportunity and the call option and the ability to compound over time, it's truly, truly a wonderful testament to the royalty and streaming business model. Because not only do you get that, which is very rare, very, very rare to find this in any other type of business, but you also have that optionality of exploration upside. So if these mines that they've got royalty contracts on and they say it's a 15 or 25-year mine, life of mine, they're highly likely to continue looking to extend the mine. And these guys get all of that additional upside. It might be 5-10 years worth or more of production for free operationally, so they don't have to pay to have that, and they don't have to pay for the capex to build out that mine. So very, very, very important point that people seem to miss. At the time, remember, things were a little different back then. Yet Gold Royalty stock is on offer for roughly 0.3 or 30% of book value, less than half NAV, and less than 15 times cash flow, which it's looking to get free cash flow positive this year for the first time, whilst growing revenues at over 100% year on year, with, as I mentioned, the massive call option on over 198 exploration projects. So, subscribe. What more do you want me to say? Gold Royalty today, here's a quick and dirty overview. Very, very misleading to look at these charts because always screen is expensive, unless in this case you were to use the price to book. When you look at the forward revenue multiples, that's fairly typical of this type of business. And I believe you'll find that continue throughout the next decade as people will be hard pressed to find something with embedded inflation protection let alone upside. And hence why I've started to really, really, really think long and hard about derivatives of these inflation. Okay, so here we are. This is the analyst estimate. Okay, this has shown how well they've grown up until this point in terms of getting the revenue. Now it's all about hitting scale for the company. I'm going to use some production estimates and underwrite this at my own estimates for precious metals pricing, a gold equivalent ounce, and they will make these look extremely conservative. So without further ado, let's take a look. I'm going to be highly confident in using gold equivalent ounces for this company. Why? Because almost all of their revenue comes from gold, and that's extremely important. Half of their, let's say half of their projects are already producing and growing, and their jurisdiction, I guess you could say, is about as safe as you can get, although you never really know these days. Currently this year, they're projecting or guiding anywhere from 5.7K to 7K GEO, gold equivalent ounces, and they're estimating that before the end of the decade, they'll hit somewhere between 23,000 and 28,000. If you remember, if you read my piece on wheat and precious metals, I ignored everything the analyst was saying, and the reason it looked expensive and I thought it was cheap was simply because I went out and actually did a first principles estimate of production and then estimate of what I thought they could get in terms of gold equivalent ounces. And so far that's turning out to be a very, very good decision because it gives you a very different outlook on the company. So we're going to do a similar thing with Gold Royalty Co. Here we have, we're fast forwarding to 2029. So imagine we get somewhere between 23,000 and 28,000 on the upper end. The median point would be 25,500. Okay. We don't know exactly what it's going to be. We don't have a crystal ball into the future, but we have to get a rough estimate, and we've just got to get it more right than the next person. 25,500. You'll notice the gold prices that I'm underwriting. The company, if you do the maths and you look at the presentation, they're underwriting $2,500 gold price. Extremely conservative. I would be very, 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 very surprised if by the end of the decade, gold's trading at $2,500 per ounce. My starting point is going to be 3K up to 4K, and there's an argument to be made that might even be conservative. If you think about how much the gold price has doubled essentially over the last 5 years, I see no reason why it can't happen again. There's nothing that I've seen that would change in terms of the global fiscal situation, monetary debasement. I don't see why that would be an outrageous claim. So anyway, have this table in your mind. I'm going to, for extrapolation purposes, I'm going to choose about 85 million worth of revenue, which is roughly in the middle of this particular matrix. But by all means, you can use your own estimates. And if we get an idea as to what kind of growth you can expect from GROY versus some of the other bigger players essentially in the field, it'll give you a reason as to why it is worth having some exposure to this smaller company, which brings some more risk, but this is where the growth option is going to be. And there's no sacrificing the business model. It's still a great royalty business model. The reason these guys will be discounted in theory is that their SG&A expenditure is a greater percentage of their revenues and their profits. So once they can get these projects into production and hit scale, their their expenses are actually going to stay fairly flat. And whilst at an earlier stage, a younger stage in the company, you see that as a greater percentage, these revenues will really start to fly. If they can get close to this production and metals prices merely hang around where they are, you'll see this huge increase in margins. This is something I just wanted to point out. So if you look at where the company are guiding, it's very, very conservative. Their top estimate, or their highest gold price was 3.6K. We're almost there already. And that would come in at roughly 85 million by the end of the decade. So just wanted to point that out in terms of, I don't think it's particularly unreasonable in terms of a target. And recurring cash expenses, 7 to 8 million a year. So you get all of this upside from where we are roughly today, slightly less than 10 mil, to almost 10x, let's just say 8.5, 9x the revenue, without the expenses going up anywhere near so much is a really, really wonderful business once it can hit scale. Okay, so we're fast forwarding out to 2029, and here I've just used the base case of around 85 million in revenue, and then at 65, 70, and 75% free cash flow margin, which is fairly typical, maybe a little on the aggressive side, you might argue, in terms of margins for this type of business, but certainly not outrageous, certainly not unheard of. They're your free cash flow estimates on the far left-hand side, and then obviously what is the market going to pay for that? Now, I think I've been ridiculously conservative here, but I think you would start this at around about 15x, 8x, 2025. You've already seen the market's willing to pay 20x forward revenues and 30x forward earnings and net income for these types of companies. But anyway, I'm trying to avoid being sensationalist. You take your multiplier and take your pick as to what you think the margins can be. And the worst case scenario, you're looking at a bit less than a double. And on the higher end, you're looking at, let's say, a 4x, possibly close to a 5x by the time this is said and done over the next few years. This is undiscounted. The last question we then have to ask ourselves is, okay, but that's in 2029. What's going to happen between now and then? The company's expected to generate some cash between now and then, so we need to give it some credit for that. This, I've gone back to being conservative and using the analyst's estimate of free cash, and then I've applied the discount rate there. So if you looked at the present value, so the discounted value of everything that's reasonably expected to come in before 2029, adding on another 59, call it $60 million worth for the company. Again, here you're looking at a potential EV discounted, adding in that extra sort of 60 million worth of present value the company's expected to produce before 2029, where we think we're really going to be hitting scale and getting up ahead of steam. And depending on what multiple you think is appropriate, you're looking at 2, 3, 4 bagger over that particular period of time. It's the end of the decade, 5 years out, 4.5 years. Currently, we're halfway through 2025. What's the lifetime value of the mines they're operating? What's the lifetime value of their sort of 242 royalty contracts? And can they add to that by the time we get to the end of the decade? And the answer is almost assuredly, of course they can. So today, pretty conservatively, when I add back in the outstanding warrants and all the RSUs, etc., to get a fully diluted share count as of today, then you bring the upside comes down a little bit over that period of time. But I still think in terms of a 5-year time frame for something like this, I think is a very, very short time horizon. So this is all well and good. We may see the company be taken over. Who knows? It would need to be at a fairly aggressive premium. In any case, the deal is not as obviously felony cheap as it was when I was writing about this and really pounding the table. The value is still there. So I'm not adding to the position necessarily, and I'm not subtracting either. I'm just enjoying the compounding. If we get a market shock and that the stock price comes back down to, mid $1, half book value, 0.3 book value, obviously then I'd look to add if I had space in the portfolio. So that's it, guys. Hopefully you enjoyed the presentation today. Remember to like and subscribe. And if you enjoy the content, if you enjoyed the thesis and the intellectual jigsaw puzzle that goes into these, please do like and subscribe to the Substack, even in a free version capacity. Thanks, guys. Take care, and I'll see you in the next video.